Hello, everyone. Welcome to the Ashworth Wealth 2025 year-end webinar. We title this Managing Your Wealth in 2025. We're going to kind of talk about some proactive tax planning strategies that we need to make sure we take care of before the year turns over to January 1. Many of these things we've been doing through reviews and wanted to kind of make sure we're not missing out on any opportunities that affect your situation. I'll kind of dive right in and kind of go through what we want to cover today. We're a firm believer that knowledge is power. The more information we can give you through education and training and meetings, the better off we are, and the better off you are with your personal situation. We want to make sure you make informed decisions. And so these educational events are meant to give you the tools necessary to make the proper decisions and do the best you can to manage your wealth effectively. As typical, we always talk about the 5 key areas of financial planning, which are preservation planning, making sure we're taking care of preserving what you have. We always joke, we say, you've already become wealthy, you've already become rich, whatever that is, you've saved this money. Let's make sure that we take care of that and preserve it as best we can. The second one is retirement planning. Retirement planning, obviously making sure we're ready for retirement, or if you are retired, make sure we have the money provided that you're going to need. The third one is tax planning. Want to make sure that we pay the least amount of tax possible. Obviously, we all pay taxes. We want to make sure that we do it in the right manner and understand what kind of tax arbitrage situations there are to be able to grow and develop your plan in a more effective manner. The fourth area is estate planning. We like to always make sure we're looking at everybody's estate plan in the spring, make sure what's changed. Are we on top of all of those ideas? And the last thing is investment planning. What can we do to make sure that we have the portfolio invested in a manner to give you the best chance for success for the level of risk you're willing to take? 2025 had some really interesting dynamics for investors. We've seen market fluctuate quite a bit, especially the U.S. market. There was a lot of talks about tariffs. There was a lot of talk about war, but even with that, we still hit new highs in the S&P 500. And so we'll kind of talk more about that lately, but there's still some concerns. A lot of people are, we always joke that economists have predicted 11 out of the last 4 recessions, obviously joking that the economists are always predicting doom and gloom. But in the long run, the real question is this: are the equity markets growing? Are people buying more things? Are people investing more? Are people doing more things? And as a general rule, the answer to that is yes. Yes, there's going to be some ups and downs. We'll talk more about that here in a second. This slide shows what happened this year. Now, this only goes through the middle of September, so it's about a month or two old. But the purpose wasn't to show exactly where the market is today, because clearly we just recently hit all-time highs again. But you can see the correction that happened. First between first and second quarter of this year. That correction was right around the time that the tariff strategy was announced by the current administration. We had markets were doing great, and then all of a sudden they went really poorly. It was about a 20% correction. The U.S. equity markets were down a little over 10 or 12% during this time for the year, but it was about a 20% correction from the high. And so that was kind of had some investors a little uneasy. Obviously, after that, once businesses kind of understood what the rules were, once they understood what they needed to do to be profitable, then they could say, okay, we're going to manage our businesses accordingly, and the market has continued to grow since then. Remember, in the short run, markets always move based on fear and greed, but in the long run, markets always move based upon profitability, and are the companies growing their profits. And so in this scenario, while it looks challenging when these things happen, these are very normal. We've talked before, and we'll continue to talk again, that this correction of about 20% from the high to the low is not abnormal. The historical average for the last 45 years on corrections, or at least the average intra-year decline in the market for the year, is about 13.5%. So in a general year, you're going to have about a 13.5% decline in the market while the average annual return of the S&P 500 over that same 45-year period is about 11%, 10.5, 11%. So in order to get that return, you've got to be able to put up with a little bit of uneasiness, a little bit of market corrections. It's those people that understand this and don't make any emotional decisions usually end up benefiting in the long run. So that kind of gives you an idea of what happened this year. But it was pretty much almost all tariff related. There was a shock to the market when the administration comes out and says, hey, we're going to do this. And this is why we're going to do it. Whether people agree with it or not, the market wasn't prepared for that. It shocked it, and then eventually, once they kind of figure, okay, this isn't going to affect us that much, or this is how we're going to deal with it, then you're able to go and manage accordingly for each company individually, etc. Some of the concerns that people have right now: what's the direction of inflation? What's going to happen with interest rates? And what's up with geopolitical unrest? This is going to be the book that we're going to continue to read from for the next several years. Inflation is going to continue to be one of those things that we watch. We didn't have to worry about inflation for so many years. It was so low that nobody really cared. That's kind of changed now. Interest rates have continued to move in a downward direction, and there's going to almost always be some level of geopolitical unrest. No matter what people try to tell you, there's always people fighting for power and doing different things. So we'll kind of keep an eye and see how that affects portfolios, etc. Inflation has actually dropped quite a bit from 2022. We had hit some highs of about 9%. This chart shows it currently at about 2.9. The latest one that came out last month, we're actually at about 3% right now. So inflation is still kind of hovering in that 2.93, 3.1%, and so we'll kind of keep an eye on that. Obviously, the Fed moved and lowered interest rates to kind of help the economy last month, and that obviously affects inflation as there's more money in the market because as people can borrow more money at a lower rate, that will tend to affect inflation. So there's not this balancing act that the Fed has to deal with from an inflation standpoint. So we'll kind of see how that goes. But you can see here that it's currently says here 2.9. The most recent one is 3.0. So it's kind of still hovering in that basic area. Interest rates are currently, this slide is about a month old, but they've actually dropped a little bit since it says 4 to 4.25. It's actually 3.75 to 4.0 is where they're currently targeted at. We want to kind of see these continue to drop if you're a person that's borrowing money. Obviously, if you're a person that's saving money and you want to put money in CDs and money market accounts, you don't like to see it drop at all. But I think what's interesting is because interest rates have been declining, everyone's bond portfolios have been performing very, very well. We've seen bond portfolios earn as much as 5.5%, 6% this year because of the falling interest rates. So we'll kind of continue to keep an eye on that and make sure that we're on top of what's going on. We want to be careful not to put too much faith into trying to time interest rates or anything like that. We want to make sure that we're very strategic and very intentional about how we deal with bonds. Bonds are primarily in portfolios not to earn a yield, but to give you buffer on an equity portfolio. So when you need to pull money out, you don't have to worry about is the U.S. market up or down. So we'll kind of keep an eye on how that looks. But for the most part, it is nice to have interest rates a little bit lower. That'll help people that are borrowing money for houses and other situations like that. Clearly, we've continued to see geopolitical unrest. There's still ongoing struggle in the Middle East, Ukraine. We'll kind of just see how this goes. But for the most part, that doesn't affect our portfolios. Most of our portfolios we're dealing with primarily U.S. markets and the Western Europe and Southeast Asia, that type of thing. And so there's not a lot of political unrest there. Now, obviously, if China were to invade Taiwan or something like that were to happen, obviously that would probably take a toll on the markets. But for the most part, most of the geopolitical unrest going on right now is not really affecting too much of the equity markets as we look at that. So they continue to move up. As a general rule, there's the population of the world continues to grow. There's more people needing services, or more people needing goods, etc. We'll kind of see how that affects things going forward. So what does it look like for the remaining of 2025 and maybe even into 2026? As usual, we want to make sure that we're always looking at things from a long-term versus a short-term perspective. Obviously, Short term is important to look at because it's affecting us on a day-to-day basis. But for the most part, we want to have a long-term outlook. Markets don't move in straight lines. They're always a long-term commitment, like I mentioned prior. There's the average entry or decline in the markets is about 13.5 to maybe 13.7%. But even though you may lose that much during the year, by the end of the year, the average rate of return has been closer to 10.5, 11% over the last 45 years. So we want to make sure that we deal with that in the proper manner. You can kind of see how long-term investing actually benefits you. And this is just a slide that kind of shows ups and downs happen every year. This is a 40, a 30, a 20, and a 10-year performance of the market. You can see even with some of these dips that we've had, the dot-com bubble, the financial crisis, a lot of these things are very, very temporary in nature. But as humans, we tend to believe that what is going on today is always going to be happening in the future. So we're always looking at things through a glass half full mentality. Or I guess glass half empty mentality, whereas we should be looking at it through a glass half full mentality, excuse me. And so really what's happening is how do I take advantage of this? So there's some things that we do when those dips happen. We want to take advantage of rebalancing. We want to take advantage of additional contributions. We'll talk more about Roth conversions, and there's things we can do when these things happen. So we kind of we're never going to be perfect on timing, but we want to make sure that we understand that ups and downs are part of what's happening and will continue to happen as we move forward. So 4 things that we want to make sure that we're disciplined on. Number 1, we want to understand your risk tolerance and your appetite for negative returns. What's your time horizon? What's your behavior? And what's your overall strategy? Of the 4 here, the number 1 thing that can cause grief for an investor is behavior. It's number 3. And that is primarily based upon number 1, your risk tolerance or your appetite for losses. It's very, very important for us to understand how you behave. Clearly, long-term investing, most investors are better to take as much risk as possible. The numbers just bear it out. Having said that, that doesn't mean that your appetite can handle that and that you're not going to make bad decisions if it does. That's where we introduce bonds and making certain tilts in your portfolios we've done, tilting towards value, tilting towards small. There's things we can do to kind of, do everything we can to yield a higher expected return, but we want to make sure that we understand how you're going to behave. So as a general rule, most people we work with are pretty good on their behavior. They have questions, we talk about it, and we kind of make the decisions. The behavior is really more, hey, markets are down right now. What should I be doing to take advantage of this? Or, hey, I'm going to need some money for a project. When is the best time to take that, and where should I take it from? Those kinds of behaviors are good versus, hey, I heard the other day the market's going to drop. Should I move my money to cash? Those are behaviors that are generally bad towards overall investment returns. And so we want to make sure we take things into account. We always talk about there's 3 things you have to do about it, we have to worry about investing. 1, investors have control over. 1, advisors have control over. And one of them, neither one of us have any control over. Investors can control when they save or spend money, when they're going to need their money. Advisors can help with the overall asset allocation, how we invest that money, what gives us the best chance for success, for the highest expected return, for the level of risk you're willing to take. And then neither one of us have any control over the sequence of investment returns. As markets go up and markets go down, we can't control that. So we have to control the things that we can control and move forward accordingly. Warren Buffett here has a great word of wisdom here. We don't have to be smarter than the rest. We just have to be more disciplined than the rest. And that's so true. Much of investing comes down to discipline. Did you make the right decision at the right time or the wrong decision at the wrong time? And so it's just being a bit disciplined investor makes a big difference for you. So let's shift gears. You're aware of probably the One Big Beautiful Bill. We've been talking about it a little bit in our reviews. We've been talking about it in some of our other webinars we've been doing. But this Big Beautiful Bill is expected to give some economic growth to the economy, make permanent many of the individual tax cuts and the reforms of the Tax Cuts and Jobs Act that were set to expire at the end of this year. We've been talking for the last couple of years that hey, there's this big wall coming, and the rules are going to change in January 2026 if things aren't made permanent. Now, we don't get involved in the political sides of this, but we just want to get into how does this going to deal with you as an investor, and what can we do accordingly. So let's kind of jump into a couple things that changed by this. Number one, the biggest thing is, remember, I'm going to kind of spend time on the married filing jointly because most of our clients fall on this. But if you're single or head of household or married filing separately, the things look a little bit different. But the primary thing to understand is the tax brackets on the left here, this 10, 12, 22, 24, 32, 35, and 37, those are now permanent. Now, when I say permanent, I'm going to air quote it, permanent with my fingers here, that just means that they're permanent until some other Congress makes changes. They were going to expire at the end of this year. They were going to go back to the prior rates, which were 10, 15, 25, 28, 33, 35, and 39.6. But what's even more interesting is the size of those brackets are now permanent as well. The 22% bracket, where you can see between 96,000 and 206,000, that was going to, a lot of that money, or at least the 24% bracket, the 22% bracket was going to be shorter or smaller. The 24 bracket was going to dip more into that dollar amount, and the 32% bracket was going to dip even more into the 24% bracket. And so as we're doing Roth conversions and everything, we have to kind of keep an eye on these brackets. So we're doing everything that we can. So the good news is we now know what they are. There was also a double inflation bump for the 10 and 12% bracket for this year. So there's a little bit more room in those two brackets for 2025. That won't affect a lot of people going forward, just a one-year deal, because these numbers are indexed to inflation. So you can see the 10% bracket for married filing jointly under the new One Big Beautiful Bill Act is 0 to 23,850. Next year, that 23,850 will be indexed to inflation. It goes up a little bit every year. So there's a little bit of relief each year based on inflation. But the good news is we don't have to worry about what are the brackets going to be. Now, I am pretty confident that over the next 4 to 8 years, these brackets will probably change again. A different administration, a different Congress may come in and say, hey, we're going to make some changes here. I don't know that they would go down. I think there's probably a greater chance that they would go up. So we have some opportunities here to do some planning based on what the brackets look like right now. Another thing that became permanent is there's no longer any exemptions on taxes. Everybody just gets a standard deduction. You can see that I'm just going to talk about the married filing joint. Prior to the One Big Beautiful Bill Act was going to be about $30,000. Now it's going to be $31,500. So they increased that for everybody. So a little bit more. They've expanded it and became permanent as well. So if you remember back in the day, we had a standard deduction and we had exemptions for each person in the household based on certain limitations. And so now those are now no more exemptions, and we have the standard deduction becomes permanent. I think by doing this, I think the government calculates that about 80 or 85% of Americans, maybe as high as 90, are filing the standard deduction. Places where we live, where more people give money to charity, that's not quite the case. There's more people that still do itemize their deductions, etc. But for the most part, most Americans are now taking a standard deduction, which makes it a lot easier to file their taxes. Another thing that was added in the One Big Beautiful Bill Act is there's now a temporary deduction for seniors. Now, this is what was referred to on the campaign trail as no tax on Social Security. That was kind of a misnomer. That was basically a political promise that was not really exactly what they were talking about. What they did is they said, we're going for 25, 26, 27, and 28. We're going to give up to an additional $6,000 for people that are over the age of 65. And that $6,000 deduction will go against any taxes they're paying on their Social Security. What's interesting about this, it doesn't matter if you were paying taxes on your Social Security or not, or if you've even elected to take Social Security at the age of 65, you'll get a $6,000 deduction as long as you aren't phased out. That phase out starts at $75,000 for individuals and $150,000 for joint. So if you're a joint tax filer and your income is $250,000, your taxable income for 2025 is $250,000, you will get a zero deduction on this. So it starts at $6,000 per person and it goes down between $150 and $250. So kind of keep an eye on that. It goes down between $75 and $125 for individual filers. So kind of a neat little deduction. It's allowed us to do a little bit more planning this year to kind of look at what people's tax situation is. It's a great opportunity to take advantage of that. Another thing that was changed in the One Big Beautiful Bill Act is the SALT tax deduction was increased. Now remember what SALT stands for. It stands for state and local tax. Back 8 years ago, they changed this. Maybe it was 7 years ago, but it doesn't matter. They changed this where you could only deduct up to $10,000 of your state and local taxes. That's your Utah state income tax if you live in Utah. It's your Arizona state income tax if you live in Arizona. Some states don't have state income tax. It wouldn't have affected them. But this is not only your state income tax, but it's also your state property taxes on your mortgage. So if you have property, not your mortgage, but on your home. But if you have property taxes on your home plus any state income taxes, you would limit it to $10,000. Well, they've increased that for the next 5 years. It's 25 through 29. For some reason, some of these go 4 years, some of these go 5 years. But this is a lot of horse trading between political parties to kind of figure out how can we do this. But for the most part, this is a big deal. So if you had high property taxes or high income taxes for 2024 or net 2025, you can now get a higher deduction. So it's very important to understand how this is going to affect your situation. But it only lasts for 5 years, and it goes back down to $10,000 in 2030. Now, some of you may be asking, why in the world would they do it temporarily? Well, there's two reasons for that. This is both on the enhanced senior deduction, which was the no tax on Social Security, and then this SALT tax cap. A lot of these things are only going to be 4 or 5 years in length. Some are 4, some are 5. The real reason is a couple of things. Number one, it allows the government, when they calculate how this bill affects the deficit, you have the government says, okay, well, is this going to add to the deficit? It's going to take away to the deficit, etc. It's important for them to make things temporary and not permanent, because the longer tax deductions last, the more it hurts their bill's chance for being scored properly by the Congressional Budget Office, the CBO. So when they make something temporary, then they get a little bit of a boost to the people right now, but it doesn't hurt the budget in a long-term standpoint. That's the first issue. The second issue that you have to look at is it allows political parties, in this case the Republican Party, to run on this in 3 or 4 years and say, hey, if you elect us again, we will make these permanent. So you kind of have to look at this sometimes through a political lens and say, what are they really trying to do? So there's two pieces to that. So I'm sure all these things will come back up in 4 years or 3 years. Hey, if you vote for us, we're going to make those tax cuts permanent. It's a political strategy to maintain power that political parties do. Both political parties do that. And it's something that's going on right now because currently the Republicans have the power with the House, the Senate, and the presidency. So that kind of gives you an idea of why that happens. So understand the why sometimes gives us an idea of what's going through their mind. The other thing that was added to the One Big Beautiful Bill Act is the no tax on overtime, no tax on tips. This doesn't really affect a whole lot of people that we work with, but you may have friends or children or have friends with children that this affects. There are limits on this. It's basically $25,000 on the no tax on tips. You can't just basically go to your employer and say, hey, I want to make sure that I don't get paid any salary. I want everything to be in tips. That's kind of important to understand, but it also affects no tax on overtime as well. Those are also capped, and they're also phased out at $150,000 to $300,000 of joint income. So it affects people, but I think it's important to understand that most people that we're working with are not generally working for overtime or tips right now, but it may affect somebody in your family. Just kind of keep an eye on that, how that may affect them. A couple other ideas that changed: the child tax credit was expanded. The mortgage interest modifications were made permanent. You can only deduct mortgage interest on a house up to $750,000 of debt. So it used to be $1 million. That now it's down to $750,000. If you borrow more than $750,000, you cannot deduct that interest. New car loan interest loan tax deduction was created. That's basically for people that are buying a car that was either manufactured or primarily assembled in the United States. This is more of the tariff policy. You can deduct interest on that. They said you can deduct up to $10,000 a year of interest. You do the math on that, that's about $150,000 to $200,000 vehicle. So most people will not be deducting that much in interest, but you can deduct some of the interest on the car loan if it's an American-made car or assembled here in America. And they made the qualified business income deduction. That's just people that are filing business tax returns. It was a thing that they allowed people to take an additional tax deduction to get their personal tax rate down to the same rate as the corporate tax rate. So those were made permanent as well, and had a little bit higher phase-out range as well. So we won't spend a lot of time on that. If it affects you, reach out and we'll kind of talk about it. As a general rule, we want to just always make sure that we're being proactive to our tax planning instead of reactive. Remember, there's a big difference between tax planning versus tax preparation. We want to make sure that we're planning the future. We don't prepare taxes. We always make sure you have a qualified enrolled agent or a CPA or tax professional that does this. We want to make sure that we're planning appropriately to kind of take care of that. There's 3 categories of tax brackets. Now that things are permanent, I'll kind of show you what each of these are. The lower brackets are 10 and 12%. If we can maintain your retirement or your future retirement in these brackets, we have a lot of opportunities to plan. If you're in the 22 or 24% bracket, we have to calculate some of the strategies that we do. If you're in the 32, 35, and 37, we just kind of hold on for dear life, and we just say, hey, we've got to find out when we can get into some lower brackets before we do some tax planning. We want to make sure that we're sensitive to this. It really comes down again to tax arbitrage. What can I do to make sure that I'm paying the lowest amount of taxes possible in my situation? Historically, we always wanted to accelerate deductions. Now we want to plan or time those deductions. It's important, whether it's when do I retire, when do I take Social Security, because those things affect other planning opportunities that I have, such as Roth conversions. A lot of people are asking us now with some new rules going into effect in 2026, should I start contributing more into my Roth 401k? For those of you that are still working, you may want to look at that. You may say, hey, yeah, I may be paying a little bit more in tax. I go back to those brackets. I may be paying a little bit more in tax if I do that. Maybe I'm in the 22 or 24% bracket, but I know while I'm working, I can afford to pay the tax. So we call it tax insurance, where you say, hey, I'm going to pay 20 or 22 or 24 to make some decisions today, because I know that if the tax brackets ever go up, I will never have to pay taxes on that money again. So there's some things that you can do accordingly to kind of plan and accelerate those deductions and do some different things as well. So capital gains rates are permanent as well. You can see if you're the married filing jointly and you can keep your total taxable income below about $97,000, you pay 0 capital gains rate on any capital gains. That's a huge benefit. Now that's your total income, not just your capital gains income. So you add the $96,000, you add your standard deduction, you can actually be about almost $130,000 of taxable income before you start paying taxes on capital gains. So we always want to look at this and make sure, if you have a big capital gain, we want to make sure understand the benefit of harvesting capital gains and losses, and kind of look at that. If you have a capital gain for the year, is there something that we can do inside your portfolio to harvest a loss? We do that on purpose. A lot of people say, what do you mean? Why would you sell something at a loss? I thought you don't want to do that. There are times where it makes sense to take advantage of a loss to offset a capital gain in your portfolio. We can always offset as many gains as we can with as many losses as we can find, plus up to an additional $3,000 that can offset against ordinary income. So we always want to take a long-term approach. We may harvest a loss to offset some gains, but we just have to understand the wash sale rules, make sure that if we harvest those just to take advantage of a tax loss, we have to wait 31 days before we can buy it back into the same assets. We may look at something temporary for the next 30 days, etc. Before the end of 2025, make sure you've reviewed your strategy, your retirement strategies. Have you maxed out your contributions? Were you eligible for an IRA or a Roth plus a potential catch-up? So the limits are $7,000 or $8,000 there. Have you done a 401k elected deferral? Maximum there is $31,000. If you're over the age of 50, it's $23,500. If you're under the age of 50, contribution limit for simple IRAs are $16,500 plus a $3,500 in catch-up. And remember, there's an $11,250 catch-up if you're on a 401k, if you're between the ages of 60 and 63. So that $7,500 number is there for you over the age of 50. But once you turn 60, you can do an additional 50% on that $7,500 number on the catch-up, as well as the $3,500 catch-up on the simple IRA. There's a 4-year period of time where you can do an additional 50% catch-up. So make sure you're on top of that before your last paycheck for 2025. We always want to make sure before the end of the year we look at Roth IRA conversions. For those of you who are in lower tax brackets, if we can take advantage of moving money from those traditional IRAs to the Roth IRAs, it helps us because it gives us tax-free compounding, lowers your overall tax income for the long run, and it lowers your required minimum distributions. The fourth is the tax-free withdrawals also for beneficiaries. We're not always looking at this, hey, what can we do to save your beneficiaries' taxes? But we usually end up getting there by the time people in their 70s and 80s and say, hey, okay, you're not going to spend all this money. You've got a tax bracket here that may be lower than your children. It may make sense to kind of take advantage of that. But we'll look at that as we kind of look at that from a family tax bracket management. You know, what are you trying to do? Are you trying to convert just for you to save yourself some taxes? At some point, we end up getting to the point as people get in their 70s and 80s and 90s, okay, what can we do to make sure that we give Uncle Sam the least amount possible? So our goal is to do whatever you want. If you want to just manage your own personal tax bracket, great, we'll do that. If you're worried about family tax bracket management, we can do that as well to kind of make sure that the family pays the lowest taxes possible on that. There is a new provision that's permanent. If you have a 529 college savings plan that you haven't used, we use these for children and grandchildren to pay for higher education. If you have money left over in these plans, we can actually transfer that money out after it's been in the plan for 15 years. And we can do it over 5 years and transfer up to $35,000 out of the plan into a Roth IRA for the beneficiary. So if I've got a grandchild that didn't use all the money for education, I can leave it in that 529 plan, and over a 5-year period after it's been there for 15 years, take $7,000 per year and move it into a Roth IRA, which means they can access that money when they retire tax-free. So some great ideas from that standpoint. The annual gifting exclusion for 2025 remains the same as 2024. It's $19,000 per person. If you want to give, it went up from $18,000 to $19,000 in 2025. It's going to stay the same for 2026. Pardon me, I misspoke there. But if you can give up to $19,000 per person. If you want to give a gift to somebody out of your portfolio for whatever reason, please let us know. We'll make sure that you meet the requirements to do it the proper way. We do not want to have you have to file the gift tax return on your taxes for 2025 by not making it or by making an improper gift. So just be aware of that. That does not include giving money directly to an institution. So if you want to help a grandchild with some formal education, there are no limits on that, nor is the anything that you give to a medical institution for medical bills does not count as a gift. We're talking about giving somebody cash to buy a house or to buy a car or to do whatever they want. So just be aware that the limit is $19,000 unless it's for medical or educational purposes. We're still in the thick of doing qualified charitable distributions for many of you that meet those requirements. As long as you're over the age of 70.5, the minimum or the maximum this year is $105,000. That's a very high number. The nice thing about the qualified charitable distributions, they come directly from your IRA, and you don't have to pay taxes on the money that you give that comes out of the IRA to go to the institution that you're giving money to. However, because it comes directly out of your IRA, you also do not get a tax deduction. So take that into consideration. It's important to understand, was I itemizing my taxes last year? Am I taking the standard deduction? It's important for us to look at those things. This is why we use the Holista Plan software to kind of calculate, how do I do this? Do I do a qualified charitable distribution? Do I give money from other areas of my portfolio? Do I give cash? We'll look at those on a year-by-year basis. It's important to make sure that we understand how the best strategy for you. Do we bunch those returns? Remember, if you're over the age of 73 and you're taking required minimum distributions and you're also giving money to charity, it most likely makes sense to give some of that RMD directly to the charity through a qualified charitable distribution, because it lowers your taxes, number one, and number two, it meets your required minimum distribution. So keep that in mind. We want to make sure that you're aware that when these are required and are available to use for your benefit. That's it for now. As usual, we appreciate everything that you guys do for us. We appreciate you forwarding this to anybody that has any questions, as we'll have our spring client education event at Salt Lake Community College. We'll do some of this stuff in person. We'll have a dinner there and kind of go through some different slides. You'll hear from me, you'll hear from Scott, you'll hear from Robbie. We'll kind of go through some different areas. Let us know if there's anybody that you would like to forward this to. We're happy to add them to our mailing list. And as usual, please reach out with any questions. We appreciate what each of you do for us. We can't do this without you, and we're always available to answer any questions at any time. We hope you guys have a great Christmas, a great holiday season, great Thanksgiving as well, and we'll look forward to seeing you next time around. Have a great rest of the year. Bye-bye.